Every market crash feels like the end of the world. Headlines scream, charts turn red, portfolios shrink fast, billions of dollars disappear in weeks. And suddenly, everyone starts asking the same question: is my money safe? But here's something most people don't notice. In every major crash, 2000, 2008, 2020, while many stocks collapsed, some barely moved. Some even kept rising, quietly, steadily, almost like nothing was happening. So today, we're talking about 7 recession-resistant stocks that proved their strength during the worst downturns in recent history. These are companies that sell products people keep buying no matter what the economy is doing. Because here's the truth: recessions don't stop life. People still brush their teeth. They still take medicine. They still buy groceries and pay their utility bills. If you want stability when the market gets shaky, this is where you look. Let's break them down. First up is Procter & Gamble. This company sells everyday household items. Think toothpaste, detergent, paper towels, razors. These are not luxury products. They are basic needs. During the 2008 financial crisis, while many stocks were falling apart, Procter & Gamble held up far better than the broader market. Why? Because people don't stop washing their clothes during recessions. They don't stop brushing their teeth when unemployment rises. That steady demand creates stable cash flow. And stable cash flow supports dividends. Investors love companies that can keep paying them even when the economy slows down. This is what defensive investing looks like. You focus on businesses that solve daily problems, not optional wants. When markets panic, companies like this feel less fragile. Next is Johnson & Johnson. Healthcare is one of the strongest sectors during economic downturns. People don't delay necessary treatments just because the stock market is falling. Johnson & Johnson operates across pharmaceuticals, medical devices, and consumer health products. That kind of diversification inside one company makes it more resilient. During the 2008 crisis, healthcare stocks generally fell less than high-growth tech stocks. In 2020, during the pandemic crash, healthcare companies were at the center of the global response. The key here is simple. Medical demand doesn't follow the same cycle as luxury spending. It's essential. And essential businesses tend to recover faster and drop less during market stress. When fear spreads, stability becomes attractive. Healthcare often provides that anchor. Now let's talk about Coca-Cola. At first glance, soda might not seem like a defensive asset, but think about it. Even during recessions, people still buy small, affordable comforts. Coca-Cola has one of the strongest brands in the world. Its products are sold globally. That global presence spreads risk across different regions and economies. During downturns, strong brands with loyal customers tend to perform better. Consumers may cut back on expensive purchases, but they don't usually stop buying low-cost, familiar products. Brand power matters in tough times. When uncertainty rises, people stick with what they know. Coca-Cola has survived wars, recessions, financial crises, and pandemics. That kind of track record builds confidence among investors looking for stability. Now, we will talk about Walmart. Now here's where it gets interesting. Walmart often performs well during recessions. That sounds surprising at first, but it makes sense when you think about consumer behavior. When money gets tight, people look for cheaper options. They trade down. Instead of shopping at premium stores, they shop at discount retailers. Walmart's size and supply chain efficiency allow it to offer lower prices than many competitors. During downturns, that becomes a competitive advantage. In past recessions, Walmart has seen steady demand because it sells essentials at affordable prices. Groceries, cleaning supplies, household goods, these are not optional purchases. When the economy slows, value becomes king. And Walmart thrives in value-driven environments. Next up on our list is Costco. Similar story, different model. Costco operates on a membership model. That's powerful. Customers pay annual fees to shop there. That membership revenue provides steady income regardless of short-term economic swings. Costco is known for bulk buying and competitive pricing. During tough times, families look to stretch their dollars further. Buying in bulk often lowers per-unit costs. During the 2008 financial crisis, Costco's same-store sales remained surprisingly strong compared to many other retailers. The loyalty factor is key here. Membership renewals create recurring revenue. Recurring revenue builds stability, and in volatile markets, investors look for predictable income streams. Lastly, we will talk about utilities sector. Now let's zoom out from individual companies for a moment. Utilities, companies providing electricity, gas, and water, are classic defensive plays. People don't cancel their electricity when the market drops 30%. They don't stop using water during recessions. These companies usually operate in regulated environments, which means their earnings are more predictable. Many also pay steady dividends. While growth may be slower compared to tech companies, stability is the main attraction. During major downturns like 2008, utilities generally fell less than high-growth sectors because their revenues are tied to essential services. If you're building a portfolio designed to handle volatility, having exposure to utilities can reduce overall swings. Sometimes, boring is powerful. Everyday essentials companies. Finally, think about companies that produce basic consumer essentials across global markets. This includes firms in personal care, packaged foods, cleaning supplies, and pharmacy chains. The theme here is simple. Demand doesn't disappear. During recessions, people might postpone buying a new car or skip vacations, but they still buy groceries, they still refill prescriptions, they still purchase hygiene products. Companies with diverse product lines and global exposure spread risk across different economies. That diversification inside the business itself can reduce volatility. When investors rush away from speculative assets, they often rotate into these steady, cash-generating companies, and that rotation helps support stock prices even when the broader market struggles. What makes these stocks different? Let's connect the dots. These companies share a few powerful traits. They sell essential goods or services. They have strong balance sheets. They generate consistent cash flow. Many pay dividends. And they operate at large scale. That combination makes them more resilient when the economy contracts. This doesn't mean they never fall. During a severe crash, almost everything declines to some extent. Correlations increase. Fear spreads. But historically, defensive stocks fall less and recover more steadily. That difference matters. If the overall market drops 40% and your defensive holdings drop 20%, that gap protects both your capital and your peace of mind. And peace of mind is underrated in investing. Important reality check. Now let's be clear about something. No stock is completely recession-proof. There is no magic shield against volatility. Even strong companies experience price swings. But resilience is about relative performance. It's about reducing damage during downturns so you can stay invested and participate in recovery. The biggest mistake investors make during crashes is panic selling. When portfolios fall sharply, emotions take over. If your holdings are extremely volatile, that emotional pressure becomes stronger. But if you own stable, essential businesses, the drop may feel more manageable. And that makes it easier to stick to your plan. Why preparation beats prediction? Here's the bigger lesson. You don't need to predict the exact timing of the next recession. That's almost impossible to do consistently. Instead, you prepare your portfolio so it can handle downturns. Blending growth stocks with defensive names creates balance. Adding exposure to consumer staples, healthcare, utilities, and value retailers reduces reliance on one single sector. When markets are booming, defensive stocks may not be the top performers. They might look boring compared to fast-rising tech names, but when markets reverse, boring becomes beautiful. The goal isn't to win every year. The goal is to survive every cycle. Because long-term wealth isn't built by avoiding every downturn. It's built by staying invested through them. If you position yourself before volatility hits, you won't have to scramble when headlines turn negative. Because in the market, survival is power. And the investors who survive downturns calmly are the ones still standing strong when the next bull market begins. Prepare. Don't panic.